Hi, this is Dr. M.N. Prakash. Today I'm going to give you a presentation on the stock market overview. So before I do that, let me share a few things about myself. I have a PhD in systems engineering from University at Buffalo, and I have worked most of my career in corporate strategy, where I used mathematical modeling for lots of analysis and forecasting. So what I want to do in this presentation and going forward is to share some of the insights from my experience and how these insights can help you pick the right stocks and you'll be able to make some money. Okay. So let me start the presentation. Okay. And here is the presentation. I hope you can see it. Yes. Okay. So this is a tutorial. It's a small tutorial, has around 6 charts, and that will give you some basic information about how the market works and how you can invest. Okay. So let's go to the first chart. So in the US market, in the US stock market, there are literally thousands of companies. So how do you track the performance of these companies? There are 3 popular indices. One is a Dow Jones Industrial Average, which tracks the performance of the 30 largest companies. Then there is the S&P 500 that tracks the performance of 500 companies in the stock market, the top 500 companies in the stock market. And there is NASDAQ 100, which tracks the performance of the top 100 companies in the NASDAQ market. Okay. But in general, when somebody talks about how the market is doing, they talk about S&P 500. It's a broad-based index, and it fairly represents the economy. Almost all stocks in that S&P 500 represent how the general economy is doing. So here's a chart I've shown you, and this is a chart of S&P 500 for the last 10 months in 2022. So you can see that the market has really done badly this year. The market was around 4,700 in the beginning of the year, and now it has gone back to around 3,700. So it has lost 20% of its value. And this is as of October 4th. So why did the market go down, right? The market went down in 2022 for 3 reasons. One is the inflation started going up, and inflation is bad for the economy in general. To control inflation, the Federal Reserve Bank started increasing the interest rates, and high interest rates are bad for the stock market. And added to that, we had a geopolitical event which disrupted the energy markets, and that was the Russian attack on Ukraine. So all of that made the stock market go down. Of course, it doesn't go down in straight line, it goes up and down. So how do you invest in a market like this? So one way to do is what I call as, or what people call as, dollar averaging. So you would invest, let's say periodically, let's say every month, and you invest a fixed amount of money. So sometimes you'll get the stock at a higher value when the market is high. Sometimes you get the stock at a lower value, but on an average, you'll do better than investing all the money at one time, let's say in the beginning of the year. So that's a popular way of investing in the stock market. Okay. So some more details on why the market goes down or go up, right? So it's fundamentally driven by the macroeconomic outlook. The stock market is a forward-looking machine, so it wants to perform based on what the outlook is going to be, the economic outlook is going to be, right? So things like, what is the GDP growth going to be going forward? What is the interest rates going to be going forward? Unemployment rate, inflation. Now, in addition to these macroeconomic trends, if there are geopolitical events happening that can upset the market. And then systemic risk, if there is a risk like the financial crisis we had in 2008, 2009, which can cause worldwide recession, and a global crisis like COVID, a pandemic that can also cause a lot of disruption. So you can see here that the real GDP, the US GDP, has, is usually between 0 and 5%. But in 2020, we had a really bad first half because of the pandemic. And then as the market started recovering, as the economy started recovering, it started going up, right? And the GDP grew. And then it started growing again. But again, when the economy slowed because the Federal Reserve Bank was increasing the interest rates, the GDP went down. So this is how the GDP tracks based on what the interest rate is, what the inflation is, and how the economic activity is because of these factors. Okay. So what about individual stocks? So why should I invest in just the overall market? Why don't I invest in individual stocks? Because that could be more lucrative. And in fact, it can be. So here is an example. Here is the Apple stock, and here is the overall market. And you can see, compared to how the overall market or the S&P 500 did, Apple has done almost 7 times better than the overall market. So if you had invested $10,000 in S&P 500, in 5 years, your gain would be like around 4,200. Whereas if you had invested the same amount in Apple, your gain would be around 28,700. So obviously, if you pick the right stock, you can make a lot of money in investing in individual stocks. But how do you invest in individual stocks? It's a little bit of work. It requires a lot of research. You need to understand what the drivers are. You need to understand what is the earnings growth potential for the individual stock, the company. What is the price to earnings ratio that people assign, the investors assign for stocks like this? What is the cash flow? What is the debt level? And most importantly, what is the guidance they're giving about the future business? Is it good? Is it bad? All of those things can affect the performance of the stock. In addition, you need to know what is the product they're making, what are the end markets for their products or services. Is that market growing? Do they have any technology leadership? Do they have any patents? Do they have a market share leadership? And how is their balance sheet? All of these can affect the performance of the stock. So it requires a lot of work, a lot of research. So what I intend to do is synthesize the information that is available about individual stocks and give my opinion on where the stock is going. And I'll start doing that next week. Okay. Now, you don't want to put all your money in one stock or two stocks. You really want to have a diversified portfolio. And the portfolio should be balanced. In other words, you don't want to have all the stocks in one sector, like the technology sector, or in another sector like the consumer sector or real estate. You want to have the stocks that are distributed across the spectrum of the economy. Okay, and how do we do that? S&P 500 helps you with that. So here is a chart that explains that, right? The S&P 500, the stocks in the S&P 500 belong to 11 buckets, and these sectors, are listed here. So we have the communication services, which is AT&T, Verizon, T-Mobile, the cable companies like Comcast, then media companies like Google, Meta, and even Paramount. Then you have consumer discretionary stocks. These are the stocks which the products and services they provide, people buy, but they don't need it all the time. If the economy is bad, they may not buy those things, so they are bad in a bad economic situation. Consumer staples. These are stocks where consumers will buy them whether there is recession or a good economy, like soaps, like shaving cream, blades, like the Procter and Gamble products, for example. That's the one example I was giving you. Or you go to certain stores like groceries because you need food. So those belong to the consumer staples category. Then the energy stocks, whether it is a fossil fuel stock like Exxon or Mobil, or even green energy stocks. Then these are financial services companies. These are like banks, insurance companies, credit card companies. They all belong to the financial sector. The healthcare companies, that can include pharmaceuticals, hospital management companies, health insurance companies. They all belong to the healthcare sector. Industrials, large industrial companies, companies like Honeywell would come under that sector. Boeing would come under the sector. Materials, these are companies that do either basic material things like copper, iron, aluminum, and things like that, or manufactured materials like chemicals. Then the real estate companies, these are the companies that invest in buildings, in cell towers, that type of thing. And technology companies, of course, Apple, Microsoft, those companies come under technology division sector. And then finally, utilities. These are companies like, Con Edison, Atmos, Energy, that type of thing. So these 11 sectors are presented in this wheel. So what this wheel shows you is in the S&P 500, by market cap, how much of these companies occupy the space. So for example, as of October 4th, 24% of the S&P 500 market cap was in technology. On the other hand, only 2% of the S&P 500 materials stocks were in that sector. And similarly, healthcare is big too. 15% of the stocks, are 15% of the market cap are in the healthcare sector, whereas 13% of the market cap is in financial companies, and 12% of market cap is in consumer discretionary companies, like that. So it's distributed. So when you invest in individual stocks, you want to make sure that the stocks you own are also distributed in these sectors. You may want to, you may not want to invest in certain sectors because you may say utilities is not my style, I don't like them, or you may say materials is not my style. But when you do that extra money you have, you want to invest in a sector where you think the prospects are better. So you want to overweight that sector, right? Even if you want to invest in all the sectors, you may want to overweight the sectors where you think the prospects are better, and underweight the sectors where you think these prospects are not good. For example, for 2022 so far, the energy sector has been very good because of the oil crisis we are going through, the energy crisis we are going through because of the war, right? So now let's come to the sector performance. So, what is the easy way? The easiest way for me to invest in the market is the exchange traded funds, or the ETFs. So here's an example, right? The SPY is the ETF that tracks the S&P 500 index. So the easiest way for you to invest is put money in SPY and forget about it, because that money will perform as good as the market. If the market goes up 20%, SPY will also go up 20%. If the market goes down 20%, SPY will also go down 20%. So you will do no better or no worse than the market. Or you may want to invest in QQQ, another ETF, which tracks the NASDAQ 100. So if you are big on technology and growth companies, which are mostly in the NASDAQ 100, and you like those type of stocks, you may want to choose QQQ. But on the other hand, if you want to optimize between the sectors, and you want to overweight some sectors which you think are going to do good, and underweight sectors which you think are not going to do good over the next 12 months, then you may want to invest in the individual sector ETFs, which are shown here, right? Like this XLC for communication services, the XLP for XLP for consumer staples, XLY for consumer discretionary, XLE for energy, XLF for finance, XLE for healthcare, XLI for industrials, XLB for materials, XLRE for real estate, XLX for technology, XLK for technology, and XLU for utilities. And you can see this year, different sectors have had different performance. The energy was the winner. Its performance was 46.2%, whereas the worst sector was communication services, which was minus 35.7%. Every other sector lost other than the energy, but the healthcare did reasonably better than sectors like communication services or technology. So again, if you can forecast the performance of these sectors, and if you're confident how these sectors are going to do, you may want to either overweight or underweight, depending on what your forecast is, okay? All right, so let's summarize what we have learned. One of the easy ways, or I would say even the easiest way to invest is in SPY, the ETF for S&P 500. And you may want to do dollar cost averaging so that you can smooth out the market fluctuations. You can invest in individual stocks, but it's risky, and also it involves a lot of research. And you also need to understand what are the drivers behind the individual stocks. Now, beating the performance of S&P 500 is tough, is difficult. 65% of portfolio managers, these are people who manage billions of dollars, with lots of tools available to them, with lots of research staff telling them how the market is going to do, and yet they don't beat the S&P 500. So it's a very tough thing to beat the S&P 500. Now, one way you can try to optimize your portfolio is by playing in sector ETFs. In addition to SPY, you may want to add certain sectors which you think are going to do better over the next 12 months. So you're kind of overweighting the market in those sectors, your stocks in those sectors. Okay. So every week I'll upload a presentation wherein I'll talk about a few stocks. And if you are interested in giving me some feedback, you can reach me at mnp@dermavision.com. Okay. So let's see what is the plan going forward. So each week I'll address 2 or 3 sectors, and I'll pick some stocks in these sectors, and I will come up with a buy list and target prices. It may be 3 stocks, it may be 4 stocks. And then for those, I'll give you a profile. I will tell you why, what is good about the stock, what are the risks involved with the stock, and also potential return on those stocks. Okay, I hope you tune in. Okay, thank you, and we'll keep in touch. Bye.